All right, let's get back with it. Part two of the stock analysis. We're in our second industry now, and we're going to be talking about the solar industry, something I'm also interested in as an investor, because truly I think electric vehicles and solar are going to be a big deal coming soon. Um, so the first company we're starting off with is called Solar City. I've been following this one for a long time. No surprise, it's also run by Elon Musk, the same guy that runs Tesla. So naturally, I like the things he's doing. But before I knew anything about ratio analysis, I thought this was a good idea. And on second thought, when you start looking at the numbers, it kind of makes you a little shaky. All in all, it's negative numbers. Across the board. They haven't posted any earnings. They're kind of like Tesla. They're swimming because they're trying to do everything on their own. But I think it's got some long-term potential, especially if they do partner up with the Tesla company like they've predicated in the news. A few positives. I want to point out that they are improving their ROE over time. They got it to about negative 8% now, so that's good, while keeping leverage level. I think that's an important thing is, never go after more debt just to magnify your gains, for the sake of making the investors happy. They've also driven down the cost of capital a little bit, which is important. And solar companies, it gets pretty crazy because they get grants and loans and all kinds of different stuff that aren't typically open to other companies, just due to the fact that it's renewable energy, and that's a big deal these days. Let's head over to their ROIC chart. Looks kind of just like Tesla's, way all over the place. No real consistency. Like I said, you can see that the WACC's starting to get driven down. But they have been able to improve their return of capital, which is important. So one thing I do want to point out that I wasn't aware of until I started doing the analysis in respects to the supply chain. Doesn't surprise me that they only have two suppliers. Like Tesla, they do a lot of the stuff in-house. However, they're in bed with Home Depot, Intel, and Walmart. So I was pretty interested when I found that out. And I'm anxious to see where that goes in the future, what applications it'll have for Solar City. On to the next company. It's a company called SunPower. They're all right. They're not necessarily clear in house. So they've improved their ROE from year to year, ending in 2014 with 19%, which sounds good. They've managed to keep their leverage level. However, the ROA is driven by high profit margins, which is good, but they've not really done much on sales, so the total asset turnover. But what lost it for them, for me, was the high cost of capital at 17, almost 18%. So that's a little high, and I should have dug into it a little further to see exactly how it's divvied up as far as their capital structure, but still almost 18%. That was higher than the rest of them, and that's just not something personally I'd be interested in. And all in all, they could barely afford their debt with a 3.61 times interest earned. I took a shot at this one trying to guess or calculate the future price a year out from now, EPS times earnings per share. Last 12 months, they managed to pull off 60 cents per share, but I got 18.62, and I think right now they're actually trading about $10 higher than that. So I'm not sure. This is our ROIC chart. You'll see this dip here in 2012 with most of the companies. Not sure what was going on there. Probably something in the market across the world. But one thing is that all three of these ratios are going up proportionally or with respect to one another. Typically, I like to see the WACC to start heading down. But all in all, they are improving the economic value added and the return on invested capital. So, no respects or no concerns with respect to supply chain on this one. Heading on to First Solar. So First Solar ended up being the winner out of the bunch for the solar industry. I like First Solar because it had a good ROE and it had a good equity multiplier compared to the other companies. The total asset turnover was pretty stable. They have really high profit margins, which is a positive thing, and they've improved the ROE year after year after year. What did it for me though was they had a smaller weighted average cost of capital than the other contenders, but as far as their debt's concerned, they knock it out of the park at 214 times interest earned. So no concerns there about meeting their obligations, especially in a speculative industry. It's nice to see that they have the means to cover their debts. Head over to the ROIC chart. Same dip, 2012, but they're at that convergence where I'm anxious to see how it's going to go in the future. You know, hopefully they'll get the WACC down and get the economic value added going up, and along with the ROIC going up, and get some separation between the two. That'd be a nice thing to see. And then as far as their supply chain is concerned, I was also surprised on this one by the types of customers they're in bed with, specifically Berkshire Hathaway. I thought that was interesting. General Electric, Sempra Energy is a company based out of pretty much the entire West. I've been following for a while. It's a really solid company, and they do a lot of solar stuff, so maybe some good partnerships in the future. And then I believe that's it. But Berkshire Hathaway, I'd love to dig into that a little further and see exactly what's going on there. I mean, you can't go wrong with Warren Buffett. And let's head over to SunEdison. So this one's pretty interesting. About a few weeks ago, it was trading at $30-something a share, and just due to some negative news, it's been brought to its knees. It's now down, trading at $3 a share. Lost a ton of value. Luckily, it's not one of the ones I own. They have terrible numbers across the board. It's kind of hard to discern what exactly drove it down so far. Maybe just because their earnings and the ROE, it's all negative. It kind of it's in that same category as a Tesla would be, where negative news just does it all kinds of bad. They haven't done much to improve their cost of capital. They can't afford their debt. Their debt's actually through the roof at 39 with the equity multiplier. They're barely moving anything with the total asset turnover. It's just it's a crazy picture with SunEdison. So no idea on the future price, as you can appreciate the question marks, but we'll see how they do in the future. And then the fifth pick from the solar industry was Canadian Solar. Now there's the ROIC chart for SunEdison. Everything's headed down in the wrong direction, just like I pointed out with the ratios. So Canadian Solar, they're kind of all over the place. It's hard to get an idea, especially with the ROE being 4,000% in 2014. If you take a step back to 2013, 9% ROE, doing all right. They're just kind of inconsistent across the board, though. That was the qualm that I had. They have losses due to high EM. Or they lost. I take that back. They actually lost the competition when I was picking the stocks due to the high EM. It was kind of higher than everybody else's. Although the cost of capital is a little bit lower, they're just kind of all over the board for me, and they're not hitting it on all the right ratios. Took a guess at their future price, and I came up with $20.74 a year from now. We'll see how that unfolds. And then as far as their ROIC, same dip in 2012 that everybody else suffered. And these kind of show a little more of that inconsistency, how it's all over the place. in respects to the ratios, but all headed in the upward direction. Although I'd like to see the cost of capital headed down. You know, if you look at just in 2015, the 14 to 15 period, it looks like they're trying to get something going. But 13 to 14 was where they really did well. So, who wins? We get it down to pretty much, is it going to be Toyota or is it going to be First Solar? To me, they were pretty much about even as far as I'm concerned, except when it comes to risk preference. I tend to go a little bit riskier. Plus, I think the long-term evolution of a solar company compared to just a standard automaker, I think there's going to be a little more value added to the stock sooner than later, unless Toyota does something major. So, like I said, it's a risk preference for me. I pick First Solar to be the best out of the two companies because of the better future aspects of what solar energy holds, and also they are more speculative with less of equity multiplier. So I kind of put that as a feather in their cap, and that was what won it for me. So, all right. Well, thank you for listening. I appreciate it. Have a good one.